Hi everyone, welcome to the latest edition of our Catapult Education series. Today's topic is around income. A lot of clients come to us when they're looking at retiring or getting to that stage of their life where they're considering retirement and talk to us about how they can get an income stream that will support their lifestyle. The number one point to make here is that your assets don't pay for your lifestyle, the income stream from those assets does. So your income stream will dictate how you live your life. Income streams will dictate how you pay your bills, how you go on holidays, and how you pay for the things that you really enjoy. The assets themselves are just going to help generate that. So a key philosophy here at Catapult Wealth is to work with you to help build the best income streams that are going to support your lifestyle down the track. So the questions that a lot of clients ask themselves is, Tony, do I have enough assets? Are my assets going to last me throughout my lifetime of retirement? These sort of key issues come up time and time again. So they're the problems. What are the solutions? Fundamental issue that we talk about with clients is making sure they understand the difference between their capital and what their capital growth is and their income streams are. And to give you an example around that is a simple example around rental property. Rental property in the city of Adelaide, you pay $400,000 for it and it generates a $300 a week income return. The $300 a week income return is going to turn up in your bank account and you know what it is. The $400,000 capital, well, that may go up, that may go down, but at the end of the day, you know what that is. What's going to pay for your lifestyle is the $300 a week rental return. The same principles apply around the share market. Share market, the BHP share price can move up and down constantly. And whereas the dividend, it comes out every 6 months, generally very, very predictable, and I'll show you that in a minute, about when your dividend's going to come and how much it's going to be and how it grows over time. But the share price movement doesn't dictate any change in that income stream. So why is this important? Well, when you get to a stage of your life where you don't work for an income anymore, you want an income stream that's predictable, it's transparent, you know it's going to turn up in your bank account, and that you are going to see it grow over time. Because as you know, over time life's getting more expensive. So you want an income stream that's going to grow over time. So how do we solve these issues for clients and how do we look at this? And I want to talk about an example around the GFC. During the global financial crisis back in 2008, share prices would have dropped by anywhere between 40 and 60%. We saw BHP shares and Woolworths shares and so on drop quite dramatically. One little known fact about that period of time was that although the asset prices dropped a lot, the income didn't drop that much. And so for clients and for investors that were very focused on the income stream, they got to make a decision around, well, if BHP shares are dropped by 50%, if the income's sufficient for my needs and it's supporting my lifestyle, maybe I don't need to sell those BHP shares at a bad time. So there's a fundamental difference in your decision making and how you look at it. I'll use this chart up on the board to reflect this. So you can see here that we've shown right back to 1986 through to 2012 how an income stream from a share portfolio of the top 200 stocks has grown over time. And the base figure here is $1,000 dividends. It started there in 1986. And as you can see, up through till 1992, it's growing. Had a bit of a dip around our last recession, the recession we had to have back in the late 80s. Back in the late 90s, we had a bit of a property hiccup and a tech boom hiccup. Back there you can see the dividend stream, the income stream slightly dipped. Grew again through to the GFC, and you can see dividends, that drop in dividends was only about, your dividend stream only dropped here by about 12%, and already now in 2013, our income stream from our portfolio has more than increased by what it was before we hit the GFC. So the dividends from your top 200 stocks is now paying you more than what it did at the height of the boom back in 2007. This is important to remember, that this man walking up the hill is really important to remember. You don't want to be watching the yo-yo where the share prices are moving around. This steady stream of income going up is a really important thing to focus on. Income's important. We help work with you to make sure that that income turns up in your bank account a regular amount in regular periods and is a sufficient amount to support your lifestyle. Please speak with us today if you want to have a further talk about this, and we look forward to catching up with you next time in the Catapult Education Series. Thank you.